In this video, we're looking at a way how to measure the return you can get from real estate. In many ways, this is very similar how you would value the return from bonds and stocks. The advantage of this method is that you can directly compare the return to other types of investments, for example, stocks and bonds. So this is a very simple method, a very simple spreadsheet. First, I will show you how to correctly make the input and how to make the calculations. So let's get started. First of all, if you want to get updates about the portfolios of super investors, Seth Klarman, Ray Dalio, Warren Buffett, Terry Smith, and many others, you can subscribe by pressing the button under the video. You will not miss a single new video. Okay, let's imagine that you want to invest in a property and you want to rent this property. The first thing that we will need is their sale price. This is very straightforward and simple. So this is the price that you pay, for example, for an apartment. The second number is their fair value. So it's very important to know what you are doing, what you are buying. What is the fair value of these particular apartments? The area, the location, do they need renovation, etc. So it's very important to know what you are doing. If you don't know the fair value of these apartments, just don't do it. And it's better to buy them below their fair value. So for example, if their sale price is $200,000 and all these numbers are just for example purposes, they are not taken from any particular example, and their fair value is higher, $230,000. So you are buying these apartments below their fair value. Next, the rent. So this is the rent after all the expenses, after all the maintenance. So this is not the revenue, this is earnings. For example, you rent them for $1,000. Again, all the numbers are just for an example. They are not taken for particular apartments. Let's say that you know this region very well and you know that the average price increase of this property is around 5% per year. So it's very hard to project into the future. So the best thing that we can come up with is rough estimate. So again, it's very important to know the area that you are buying the property. And the last thing is the price of the rent increase. So again, let's say it's around 5%. Okay, so the sale price, their fair value, which you have to know very well, the rent after all the expenses, so after all the maintenance, the average price increase for the next 5 years, and the average rent increase again for the next 5 years. Okay, so we know all the input. Let's make the projections. On the initial year, we use the fair value of these apartments, so not the price you paid, but the fair value. So immediately you earned these $30,000 and you rent them for $12,000 per year. So 1,000 times 12. Then we project the data to 5 years. So for the next year, it will be the previous year plus 5% increase in price, both the price of the apartment and the price of the rent. So for the next year, it will be the previous price plus 5% increase in price and the rent. So we do this for both price and the rent, and we get that in 5 years, these apartments will cost around $294,000. Also, if we calculate all the rent for these 5 years and the initial year, we get close to $81,000 from the rent. So we combine both the price of this property in 5 years and the rent for the 5 years. So we combine the final price of this property in 5 years after the average price increase of 5% and the total rent during these 5 years. So the total price is close to $375,000. If we get the total return from $200,000, so this was the price that we paid initially for the apartments, from $375,000, we get the average yearly return of close to 13.4%. So here is the formula how to get the total return. Basically, you need the initial price, the final price, the number of periods. So 13.5% is the average return that you get from these apartments if you use 5% growth rate of these apartments, if you buy them below their fair value, and you get $1,000 per month for rent after all the expenses. So 13.5%. Okay, so this was a very simple method, a very simple spreadsheet that you can use how to get the return from real estate. A very similar method can be used to value stocks, to get the return for stocks. It is best used for dividend stocks or very stable, and predictive companies like Johnson & Johnson, Procter & Gamble, etc. As a result, you can compare different asset classes, real estate, bonds, and stocks. Also, if you want to know more about the recent purchases of Seth Klarman, here's the video. If you are not subscribed to the channel, you can do so by pressing the button right here. You will not miss a single new video. Thank you very much for watching till the end, and see you in the next video.